Brent crude oil up 0.5% this morning in early trade at 82.80. WTI is trading also similarly up 0.5% at 77.23. Still a spread of about $5 between Brent and WTI. A little bit of a bounce back after surprisingly markets sold off yesterday. Initial reaction to the sort of geopolitical events over the weekend in the region, the Middle East region, seemed to give an upward motion to prices, markets opening in Asia yesterday, but then calmed down a bit on that. A wait and see, it seems, and maybe on how the U.S. will react to events over the weekend where 3 U.S. service persons were killed in Jordan. Let's kick off this morning with welcoming a new guest to the table, Michelle Bachmann, a principal analyst at Lloyd's List Intelligence. Anytime I see the word Lloyd's, I always think of 18th century ships with sailings going all around the world. And ultimately, that is the origin of Lloyd's in all of its shapes and colors. So welcome, Michelle, and no better person maybe to kick us off this morning. If you could give us some context, not obviously we are well aware of the situation on the Red Sea and the disruption, shipping and so forth. I welcome the sort of technicalities of what that means for the shipping sector, what it means for insurance, what it means for delays and other elements like that. How bad is this at the moment for shippers and charterers?
Well, good morning, and thank you very much for having me on the podcast. Well, I would say that the incident on Friday has really changed charterers' perception and their risk appetite for transiting the Red Sea. So immediately we've seen Trafigura, who was the charterer behind the vessel that was attacked, has paused Red Sea transits. We've seen some charterers like Kuwait Petroleum Corp. They have stopped transits as well. I looked this morning at the charterers that were going through. So Reliance, Gunvor, Saudi Aramco, they're still sending their tankers through. But make no mistake, there's been a dramatic reduction in transits going through. We've seen most of the northbound traffic, that is your jet fuel diesel from the Middle East Gulf through to Europe and the UK, a lot of that is now diverting. And we had seen southbound transits, which were your Russian oil and products heading to Asia. They are still more or less uninterrupted, but really that's the only trade that I see that has not been impacted. No liquefied natural gas carriers are going through, very few LPG carriers going through. And I think the attacks over the last 3 or 4 days have really given pause for thought. I think we've seen a tipping point now where we're going to see a lot more traffic going through. We're down about 30% in terms of product and crude transits, and I think that figure is going to accelerate.
Let's welcome Sarah Akbar, Chairperson and CEO of Oilserve Kuwait and Non-Executive Director at Petrofac. Despite the harrowing sort of insights from Michelle there in terms of the disruption to the trade, Sarah, as I said yesterday, we saw oil prices decline. Today, they're up a few pennies, but the oil markets are looking fairly calm given the sort of context. Your thoughts on that, and does it make sense to you? Sarah, I can't hear you because ultimately you're on mute.
Okay. Good morning, everyone.
Good morning.
Yeah, good morning. Yes, I agree. It doesn't make sense that the oil prices are where they are with the amount of tension that is going in the region. I think the most significant incident was this attack on the American base that actually had like 3 casualties and 37 people were injured in this. I think that is very significant because now the US will retaliate somehow. And then the level of tension in the region is again increasing. And as a matter of fact, there was an attack on an oil tanker. So these factors put together can tell you one thing, that there is one direction for the oil price. But at the same time, looking at the world, the US is producing 13.2 million barrels. China is kind of a little weak. And I don't know if you saw the report that says last year, China has added something like 200 gigawatt of solar. So, in balance, I think those two factors, the production in the US, Chinese economy, and all the issues with China, can counterbalance the kind of tension that you have in the region. That's why the oil price is what it is.
Daniel Richards, MENA economist at Emirates MBD. Daniel, what does this all look like, its impact for the Gulf economies? Clearly, the Red Sea is a major trading route for moving goods across the world, east to west. What does it mean for the Gulf states? Is there impact yet? Should we expect that the economies in this region will feel the effects of this?
I think it's a little hard to say. I think one of the factors people have been talking about a lot with this is the inflationary pressures that might come about from it. Obviously, the longer this goes on for, the greater those risks would be that the supply chains get extended. What we've seen in Dubai, at least, is that companies are, for the most part, saying that they are absorbing the cost for now. They're not looking to put up prices as yet. So we don't really see any major impact on consumer demand in the near term, at least. With regards to the trade and logistics sector for Dubai especially, and for the UAE as a whole, that is a very important sector. Trade is an important sector. Jebel Ali, the largest container shipping port between Rotterdam and Singapore, it is a crucial sector. But for the most part, I think that the transshipment ships that would come in won't be affected as yet for this side of the peninsula, at least. I suppose there's more the startup or the newer Saudi facilities on the other side of the peninsula might see more risk. Equally, of course, Egypt is very exposed to the lower FX revenues it will get from the Suez Canal disruption. So Egypt's already, of course, undergoing significant economic and financial strain over the past 18 months or so. And this is now being exacerbated, firstly, of course, by the war in Gaza, just over a border, and the impact that will have on tourism revenues, and now the Suez Canal revenues as well. So of those most exposed, I think clearly Egypt is the most at risk, but for GCC, I don't really see any particular slowdown emanating from this as yet.
Michelle, looking at the shipping, the sort of logistics, if you like, clearly we have the increase in the amount of shipping groups and particularly ship owners. It seems there's a growing tension there between owners and charterers who still want to traverse through the Red Sea because they've got customers to serve, versus ship owners who are protecting their assets. How do you expect those two things to that sort of tension between the different stakeholders involved here? How will that play out? Who will win that tussle?
Well, I think ultimately the issue may be decided by marine insurers. As I mentioned earlier, the perception is that those vessels with commercial ties to Europe and the UK and the US are most vulnerable to attack. And so what we're hearing now in the Lloyd's insurance market is that it's becoming increasingly difficult to insure a US or US exposed or UK exposed vessel. And so those war risk premiums are rising in value. So I think ultimately there may come a point where the vessel can't get insurance, or the insurance is too expensive, and therefore it's more economical to invest in the higher fuel costs and sail around the Cape of Good Hope. I think that ultimately will rest the argument between charterers and ship owners, because there's a lot of legal and charter party considerations about whether it's safe, and usually, I think when it comes to war risks, it usually involves calling at ports. This is a new scenario because the risk is in the passage through the Gulf of Aden through to the Red Sea. So ultimately, I think marine insurers will decide who transits.
What is the domino, Michelle? What's the domino consequence of that longer journey? Do all ships make it? Do some wait? And the longer journey, then what's the domino potential now of that over the next month as this starts to really sort of feed its way through the whole supply chain?
Well, from an oil perspective, obviously you're tying up tankers for longer periods. It's an extra like 2 weeks for the voyage. So you're increasing your utilization of the tanker fleet is going to rise, and that may pressure freight rates. We're already seeing that in the market. But you have to remember that, you know, freight rates are a very small component of the overall cost. So there will be pressures there. And there are always going to be those owners and charterers that are prepared to run the gauntlet. I think the really interesting turning point will be if or when those Russia-loaded cargoes that are bound for Asia, if or when they decide to divert. Because I think at the moment, you're seeing very much risk appetite driven by geopolitical lines. A lot of ships are signaling with their automatic identification signals if they have no connection with Israel or no connection, or they've got China crew or Russian crew on board. And that seems to, there's an impression that's the magic word for safe passage, true or not.
Sarah, meanwhile, as we were saying earlier, the oil markets have been fairly, I mean, relaxed is a big word, but generally the tragedies in Gaza and now the Red Sea disruption have been, the oil markets have been fairly agnostic in terms of the impact on at least from a price point of view. And many would argue that is because there's so much idle capacity at the moment in the OPEC Plus group, somewhere around 6 million barrels a day. Interestingly, a story that just published this morning before we came on air, literally 15 minutes ago, Saudi Aramco has been asked by the government of Saudi Arabia to stop its oil production capacity raising project. They're in the process of moving from 12 million barrels a day to 13. They've been asked by the government to stop that program. Of course, costs billions of dollars to move from up 1 million barrels a day of capacity. Your thoughts on that announcement and what it tells you about the wider issues related to demand, capacity, and so forth?
Yes, correct. You know, that incremental barrel that was going to be developed in Saudi is a far more expensive barrel than the barrels being produced. So under this current environment,
in specific
forward,
terms, what does that mean? Like instead of $10, it's 20, or what does that look like?
I don't have the numbers,
but percentage-wise, perhaps roughly estimates.
It's probably 30% more.
30% more.
Yeah,
right.
It is about 30% more in production cost and in development cost, because it's just that the nature of the fields, the nature of the development. So, and you know, most of the development was actually offshore rather than onshore, which is cheaper. So it makes sense for Saudi to slow down, because I don't know when that incremental barrel will actually hit the market and what is the value that will be generated from that incremental barrel. Having said that, if you look at the bigger picture in Saudi with all the developments, the trillions of dollars that are needed, I think to put, where do you put your next dollar to generate maximum value? Is it to develop oil that will sit on the side waiting to be produced, or to put it in something else that can generate value much sooner? I think that's the kind of equation, because now Saudi is actually thinking about, you know, in their new structure, in their governance model, they actually look at things in that way. So where do you put the next dollar to generate maximum value? And definitely at this point in time, it's not on the oil and gas. So that's why I believe they are driven mostly by the economics of this rather than the politics of the oil markets. So looking forward, like I said, this year, the US is at their max, and I think maybe a little bit this new decision by the Biden administration to hold LNG export will have some impact on the market. But from an oil perspective, they are at the highest ever been. So it's back to the times, you remember 2014 when we were thinking about the shale and how the shale will compete and all of that. I think we are back into that kind of area where the US shale is genuinely competing with oil from everywhere else, and you will have a lot of oil sitting on the side waiting to be produced. So that's why this rationale of Saudi is very valid at this point in time.
Daniel, if we just pick up on that, I mean, the intersection point here where idle capacity meets sort of market share competition, and where Saudi is the biggest economy in the region, obviously they reported deficits last year, even negative growth, etc. Where is the impact of this now as it builds in terms of Saudi carrying the weight of a lot of the oil supply cuts and its fiscal impact?
Yeah, I mean, they had a fiscal deficit last year after that surplus the year before that, and we expect a repetition this year. As you say, they're taking the brunt of the voluntary production cuts, and then prices, we forecast an average of $82.5 a barrel this year. It's pretty similar to where we are now, basically. But with the oil production cuts as well, revenues aren't going to be there to support the kind of spending they're still doing. And we saw a pretty marked expansion in budgeted spending last year. While that might not come in at quite the same 10% or so this year, it's still going to be sizable. So in terms of the deficit, we see it being above 4% and a bit of GDP deficit, equivalent GDP deficits. So they are committed to this diversification program. And if they're going to remain committed to it, then they're going to have to do some spending this year. And all indications are that they will do. In terms of growth, obviously that takes a hit as well. We expect that the oil production, once again, oil economy, oil GDP will once again weigh on GDP growth as it did last year. We saw a contraction, but we estimate a contraction around 1.5% last year. Again, this year we forecast a modest contraction. The upside, of course, is that non-oil sectors still looking pretty robust, but in headline terms, these voluntary production cuts, they will weigh on the budget, and they will weigh on growth.
Let's go to the survey question, sort of the point I made at the beginning of our podcast is like how the US will retaliate to this event over the weekend. Like Sarah referenced it also in her comments. Will U.S. retaliation to the weekend attack fatalities in Jordan be of a scale that will drive oil prices higher? Do we expect America to respond in a scale, or will it simply be more, erring on the side of caution, avoiding escalation in the neighborhood, which has been, it seems, a priority in recent months? Your thoughts on that, the scale of the U.S. response, what do you expect it to look and feel like? On that point, Michelle, looking at the shipping aspect of where the winners are, if you like, from the point of view of these situations, we're seeing even globally, it seems, routes that have nothing to do with the Suez Canal, Europe to America, rates are doubling. Asia to the Middle East, or Gulf to Asia, shipping rates jumping quite significantly, where there's no Suez Canal component. What's the logic in that, and how is that likely to continue, or is that just a temporary reaction?
Well, I think, for example, what you're saying is the fewer diesel from Middle East, Gulf, etc., is flowing to Europe, and so you're seeing that being taken up by US Gulf to Europe flows. So that reflects why you're seeing freight rates that aren't, in theory, connected to the Suez Canal problems being increased. I mean, the shipping market had the biggest recalibration of trade flows when sanctions were implemented on Russia back at the beginning of 2023. And so you're just seeing a sort of mini version of this, where instead of having diesel from the Middle East Gulf head to Europe, you're seeing other, different arbitrage trades arising from that. And that's why you're seeing those shipping rates rise. But
is
really,
it a temporary reaction, or should that calm down, or will that just be a consequence? Because that's really where I suppose the ultimate pressure from this action by the Houthis, it puts that global economic pressure on inflation.
Well, I think the longer this goes on, then yes, and the tanker markets are quite unique in the moment historically, in that because of the supply and demand factors at stake, a lot of new tankers weren't ordered in shipyards in Asia over the last couple of years. So there's a shrinking supply of tankers, which puts even more pressure on freight rates. So you've got that dynamic at play as well. So, it's really hard to forecast at the moment, because the situation is literally changing day by day, even hour by hour. So based on what I see here now, with the caveat that it could all change if a tanker is hit again and there's a major oil spill, in which case rates will spike considerably, and so will the oil price. I think that, we're going to see above average freight rates, until for the duration. And of course, you're also looking at, any threat to the Strait of Hormuz from Iran is also in the mix as well.
Daniel, just pick up on that, because where does that follow through? I mean, we're in this moment where we started the year, really, it was all about whether the Fed was going to be easing or when they were going to start reducing rates. There was very strong narrative in the fourth quarter. Where do you think this development, these rising shipping costs, and of course the inflation rates themselves already seeming somewhat resistant to make that last drop down, where that intersects with monetary policy in the first half of this year? Because I know Emirates NBD had already called for no change in the first half.
Yeah, and I think everything's happened over the past couple of months has reaffirmed our view. Maybe we might see one in May, but our core view is still June. As you just mentioned, the disinflationary trend has slowed. Even prior to that, those last legs down was always going to be the hardest bridge to cross, and now we've got the added complication potentially of these higher shipping costs. Probably worth mentioning, shipping was only one element of that spike in inflation we had 18 months or so ago. Is also factory disruption, high demand, all the rest of it. But clearly that is another complicating element. We have potential fiscal giveaways in the UK, especially coming up. So we don't, and still pretty high wage growth. So we don't see anything really in terms of language from any of the major central banks, any of the data, either in terms of a rapid slowdown in inflation or a very weak economic outlook that would prompt central banks to feel they had to step in to kind of support growth. That leads us to think that they're coming either this week or even in March. And we've seen the market expectations for that March cut from the Fed really fall off a cliff from where we were at the end of last year, as you say. If there's a marked improvement over the next several months, maybe we'll see movement in May, but our core view really remains not until the middle of the year.
And even then, it seems to me unlikely, because then you're in the middle of an election, both in the UK and in the US. And you'd have to really have very just cause for the Fed, not some possibility that unemployment is coming down the road, but you'd really have to see the white of the eyes of the reason you would move, it seems to me, by the central bankers, who I don't think want to get in the middle of an election narrative. Sarah, I wanted to close out with your thoughts of where does OPEC go with all of this? Clearly $80+ is a sweet spot for OPEC producers. They are in the process of implementing yet another deeper supply cut. But like we saw the news just this morning from Aramco abandoning plans for increasing capacity, I suppose if you take the backdrop, 6 million barrels of idle capacity, why would you add more to it? Where do you think OPEC Plus goes this year with that added challenge of quotas and capacity within the group?
Well, I think, OPEC will continue to do what they are doing in order to maintain the prices at this level. So if they need to go and cut a little bit more, they will do that. But it is just to ensure that there is enough supply that can take care of, whatever demand is there in the market. So I believe they will continue to do what they are doing now, and they will just face
Clearly,
the
there
challenge.
were some
And
difficulties in the meeting in November, December, where they took
Yeah.
a few weeks to come to a consensus. That there is a growing, it appears, some sense. I mean, a group that used to have meetings that lasted minutes now struggling to get it sorted over a few weeks. There's clearly new dynamics at play here.
correct, because many countries actually do need to enhance their increase their production. Like, for example, Iraq, they need to increase their production. They have some production shut down. Kuwait needs to increase their production. So yes, there are pressures within these countries now in order to increase production. But at the end of the day, what are you sacrificing? You are sacrificing the price versus added production, more production at lower price. So at the end of the day, I think, just economically speaking, what is the best for the group to keep this consolidation, this coalition that has really worked for the last 2-3 years, to keep it in place and continue, or to just break it up and then face the consequences. So I think, logically speaking, they will continue to do what they are doing in order to keep the prices at the levels they are happy with the range of 70 to 80 is where they want it to be, and continue the
But it's
coalition. That's their best option.
It's like you said earlier, though, what's different now, I mean, as compared to COVID and coming out of COVID and the incredible solidarity and impact that OPEC Plus had in those years. But now that's behind us, we have this U.S. shale production back to a massive level. So the more you cut, the more others increase. I mean, you're back to that sort of quandary of...
I think, Sean, we have an opportunity now, because if Texas separates, then they can be part of OPEC, and then we have a much bigger OPEC.
Well, you got Brazil at least to come into the tent. I don't know if they're just making coffee in the corner. I don't believe they've made any commitments to do anything, but they're in the tent. A challenging year ahead, inevitably. Softer demand, lots of supply. What do you do with that? 50-50 in this room. Who knows what the Americans are going to do, basically, is the view here. Michelle Bachmann, thank you so much for joining us. Really appreciate it. A former colleague at Bloomberg, and nice to have you at our table. So appreciate that. Daniel Richards, great to see you again. Happy New Year. Sarah Akbar, as always, the best of the business. Thank you, Sarah. Look forward to seeing you all soon again. Bye-bye.
Bye-bye.
Thank you.
Thank you.